opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.
Hi, everybody. Welcome to episode 17 of the Macro Corner podcast, proudly presented by Blue Line Futures. I'm your host, Paul Wankmueller. My guest today is Jannis Meindl. Welcome to the show, Jannis.
Hey, Paul. How's it going today? We got a lot to cover.
Yeah. Thank you. Let's start off. The topic is fighting addictions in lonely places. And I'm going to generally assume that we're talking about the best investments mostly start in discomfort, and that might be a little lonely. Is that what we're going to start with here?
That's exactly what it is. So the best investments, as how Mark's put it, do start in discomfort. Indeed, it is this sort of herd mentality that's pretty odd in markets at large. When the price of an asset appreciates, people tend to chase that asset. And when the price depreciates, people tend to run away from it.
Yeah, and you could even say maybe the Fed is in a lonely place right here. Or are they addicted to the pressure to continue to raise rates, ignoring the market signals that the market's showing them?
In terms of addictions, I think that the market at large, being stocks, being bonds, has gotten addicted to a bear market in bonds over the last 40 years before this rally in yields began. You have had tremendous amounts of liquidity being injected by central banks globally. And now the market has to deal with coming off of that liquidity addiction that we have seen. How long will it last for? How long can they withdraw liquidity before they have to pause is the ultimate question that people are asking.
All right. Sounds good. So let's dive into that a little bit. What we were talking about earlier, how long will the Fed ignore market signals? Since the speech at Jackson Hole, the market has decidedly leaned more towards the idea of a recession. We really haven't seen the rhetoric change from the Fed with what has been happening over the past couple weeks.
Yes, and we saw Jay Powell during last week's press conference and the 75 basis points hike that preceded this press conference. We saw that he reiterated that there's been nothing that's changed since his Jackson Hole speech. So it just speaks to the fact how serious they are about raising rates, rather than the Fed trying to maneuver around markets. They probably realized that the economy is in a different spot than it was the last 10 years when we were at zero rates. And they are now adjusting to new economic realities that do include structural supply issues rather than just bottlenecks. So they are now adjusting to what is known as a new R-star, a new neutral rate. And as they're getting to that place, they want to regain credibility that's gotten lost ever since they started QE, really. So regaining that credibility is a really hard process. And whether the market will allow for them to even get to that eventual place of setting a new neutral rate within the current market regime is really going to be a challenge. And it will be interesting how do you keep communicating and whether they have a point in time where they maybe budge to some of these pressures that markets will inevitably show them.
All right. Well, yeah, and going back to another barometer here that I'm looking at is the rate of change of financial conditions versus the absolute number. And I do believe that there is one statistic that you feel is not really overdone yet, but the rate of change is spiking up to the upper range. Yeah.
So when we look at financial conditions, meaning how tight is credit, what is the market basically feeling? I mean, it is conditions. And we look at it on an absolute basis, and we realize that looking back over the course of history since the 1970s, these financial conditions are not as tight as you might think, given where stocks have traded, given how much bonds have sold off. But then we turn to the rate of change on a 52-week rolling basis, and that rate of change is towards the upper end of the range that we have seen since, call it, 1985. So given that we're coming off of ultra easy conditions as far as monetary policy goes, the effects of that rate of change is assumed to be that much more. I mean, we're talking about getting rid of addictions here. If the market was addicted to liquidity up until now, then getting off of that place, getting off of that isolated island where everybody is still wearing rosy colored glasses is extremely hard. And that's basically what we're seeing here right now. And that's why we not only pay attention to the absolute levels of financial conditions, but also the rate of change. We have heard Jay Powell, Neil Kashkari, all the other Fed governors talk about this time and again, that before Jackson Hole's major hawkish pivot in a way, I mean, this was basically a hawkish pivot after financial conditions became more easy from the prior rate decision. So leading into Jackson Hole, stocks appreciated, financial conditions eased, and these Fed governors explicitly stated that they want to have tighter financial conditions. And the tight financial conditions that we're seeing have that much more of an effect. And even though it is on a lag, that's what makes it dangerous. That's what makes it dangerous that the Fed will ultimately end up over tightening. Maybe they already have, but that we are taking a really close look at financial conditions and the lagging effects it will have on not only risk assets, but the real economy as well.
And that's in the U.S. But what about the emerging markets? Or, is it, back when we were looking at 2008, et cetera, we had many more problems over there. But how are the conditions in the emerging markets?
Yeah, so emerging markets, we do have, of course, this giant wrecking ball rolling around being the US dollar. I mean, we've talked about this in the past on this podcast. When the dollar appreciates and a country has debt in a currency that they don't control, that's a problem. But then counterintuitively, we've seen financial conditions in the emerging markets not really be that restrictive after all. So that has been one of the major surprises. And that's also what enables the Fed to be that much more aggressive in some sense. I mean, the Fed has explicitly stated, Jay Powell has explicitly stated on a central bankers panel that the level of the dollar will not be one of the Fed's targets. I mean, that's not within the mandate. But if it were to really roll over into extreme stress in emerging markets, the likelihood is that they pay some sort of attention, and then there need to be some sort of interventionist policies in response. But the fact that emerging markets, that their financial conditions have not really been as tight as one might think, given the level of the dollar, that's encouraging in the sense that it allows the Fed to keep tightening and allows them to drive a stronger dollar. And that's ultimately disinflationary in the US, but it is inflationary everywhere else where you have other countries pay with a currency that's measured against the US dollar.
I mean, one of the biggest countries, the biggest actually, that owns our debt is China. And, we're talking about the US dollar here. Let's talk about the yen versus the yuan and what's going on with that situation as that US dollar creeps to 20-year highs pretty much every week.
Yeah, so we have the US dollar story on one end, and that, of course, affects currencies globally, that affects trade flows globally. But then we have this local competition of what's in between Asian Pacific currencies. So if you look at the ratio between the Japanese yen and the Chinese yuan, that tells you that ratio going above 20 and making new highs ever since the late 1990s tells you that there's ultimately a competition for exports and who can export in a currency that's most competitive on an international scale. So as the Japanese currency depreciates and the ratio between the yen and the yuan goes up, that tells you that in order for the Chinese to stay competitive, the next logical step would ultimately be a devaluation of the yuan. What would that mean? That would ultimately threaten the degree of holdings that the Chinese can have in U.S. Treasury markets, because if their currency gets weaker, then they cannot afford as many dollars. So that would be net positive for yields. That would be net negative for commodities. And it would probably also be quite negative for U.S. stocks and risky assets globally. So we're watching the Chinese yuan real closely, as it is could be one of the major black swan events that there's currently out there. And the Asian currency space at large is really interesting, given where the Japanese yen, but also where the Korean won and all the regional currencies have traded, and then that all these countries compete for exports, so they need to keep their currencies competitive on a regional scale.
All right, that sounds good. And we can just close it out here. Just to reiterate, the rates have been raised at the fastest rate ever in history. We always talk about the 2s and the 10s. Any update on the 2s and 10s?
Yeah, so we have seen the 2s, 10s yield curve trade at negative 50 basis points last week. It's come off a bit right now, trading at negative 41 basis points. But what we are basically observing here is that the market is screaming at the Fed that an economic slowdown is ahead. The question is, when will the Fed listen? When will they let market signals do the talking rather than they themselves do it?
I love it. Jannis. Thank you very much for coming on to episode 7 of the Macro Corner podcast. It's always a pleasure. Don't forget, the Macro Corner chart book is available in the description of the podcast on bluelinefutures.com, as well as attached to the email sent to clients every Sunday. Not a client? Reach out to podcast@bluelinefutures.com for a 2-week complimentary trial of our premium research covering equity indices, bonds, metals, grains, livestock, and more. Thank you very much for joining me today, Jannis. I look forward to speaking to you next week.
Looking forward. Thank you.
Have a good night.
All opinions expressed by the program participants are their own and do not reflect those of Blue Line Futures LLC or their affiliates. The content is for informational purposes only and should not be taken as trading advice. Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for your financial condition.